All righty. I hope everybody had a good break and an opportunity maybe to go outside. I'm hoping that the folks who did go outside actually came back. So that's really good. I'm really excited to build on David Hoffer's introduction from earlier. As he said, he's been doing this presentation on the sort of investor's perspective on principles of finance for a number of years. And I think he's doing it for two different reasons, or the reason we keep inviting him back is maybe for two different reasons. One of them is his background covers a whole bunch of different areas in a sort of integrated way that are really very cool, because he has both a finance degree from Harvard MBA, Harvard Business School, and a law degree from Harvard Law School. And bringing those two perspectives together is really, really valuable as you're thinking about the basics here. And secondly, he's one of the clearest speakers I've ever seen in terms of taking, as Lee said, intimidating material and making it accessible to wider audiences. So with that, I will get out of the way and let David come up and talk a bit about his work.
Thank you, Brad. I'm now utterly intimidated because I now need to live up to all those expectations, and I don't think you're supposed to use the H word in New Haven, so I'm going to flee the stage afterwards. Thank you all for being here. So my job today is to explain how private investors look at the conservation finance landscape. And in particular, to give you some insight into how investors think about the process of putting capital into conservation projects, because for those of you who are in the conservation NGO world, you either have had or hopefully will have the opportunity to work with private investors, and it's useful to know how the people sitting across from you at the table are viewing things. I'm mindful that in thinking about the previous presentation, Lee explained that you start with the easiest money first, and you work across from left to right, and private equity and private investment capital is at the right end. So it's only occurring to me now, after all these years, to wonder why it is that we start with the most complicated possible financing. And maybe it's so that the rest of the week looks easy. But in any event, I will try to bring this to a level that that everyone can follow. And invariably, what happens in a group like this is there are some folks who have never seen the inside of a spreadsheet. And then there are usually a couple of wayward investment bankers who got lost on their way to the School of Management and wandered in. And those folks are invited to take a nap or heckle from back, because I will try and explain this at a level that doesn't assume any financial knowledge whatsoever. By way of further background before we dive in, the name the Lyme Timber Company has come up a few times already this afternoon. Lyme Timber Company is a timberland investment management organization, which is abbreviated TIMO. And I think if I define it first, I don't have to contribute to the swear jar. We are TIMO. We are an organization that takes money from investors and looks for ways to invest it in timberland and other rural real estate that where there is some conservation thesis. And that's what differentiates us from other TIMOs, is that we are looking for opportunities to invest in a way that generates investment returns, financial investment returns for investors, and also durable ecological or environmental benefits. We've been around since 1976, based in Hanover, New Hampshire. We have, over the years, raised funds, a number of investment funds, which we then deploy in finding interesting properties to invest in and generate returns and achieve conservation outcomes. And then we typically sell them to somebody else, and have been doing that for a long time. We currently have $760 million, how much? $760 million under management, Lindsay? All right. So we have been investing in these conservation-oriented transactions really since long before the term impact investing or ESG investing was ever invented. And now it's a very popular thing, and we're still doing it. So that's by way of introduction. The presentation is really divided into three parts. I'm going to start out with really a case study, because I think that that's often the easiest way to have a concrete understanding of what it is that we're talking about, and use that to illustrate how a typical transaction is structured. We'll then go to sort of the 100,000-foot level and talk about what motivates private investors and how they think about putting capital to work and what they're trying to achieve and what they need in order to put capital into a project. And then we're going to dive down to the very granular level and talk about basic principles of finance. What is internal rate of return? What is equity multiple? What does it mean when for investors to try to quantify how much they're going to get out of a transaction when they put money to work? So three sections. Last point is, please interrupt me. I will scan the folks here in the room. I can't scan the people online for quizzical or confused looks, but rather than making me guess, raise your hand, and this is, if you have a question, probably 3 or 4 other people have it as well. So I'd rather do it interactively than have people be confused to the end. Okay, so part one, how a typical transaction works. And this is typical for the Lyme Timber Company. There are other ways to think about transactions, but enough of the elements are common that I think it's useful to have a framework like this. So to have an investment transaction where private investors are putting money into a project that's going to have a conservation benefit, what do you need? Well, first of all, you need somebody who owns a piece of property that they're willing to sell. And there are a variety of types of owners of property. There are TIMOs. There are public real estate investment trusts, or REITs, Weyerhaeuser, Rayonier, names that you may have heard, that own a lot of land. Individuals, families own big pieces of property. Corporations own big pieces of property, but you need to have identified a piece of property, because otherwise you have nothing to invest in. And typically for folks in the conservation NGO world, this is not a hard problem. You've all identified lots of pieces of property you'd like to conserve. It's just a question of how to make it happen. So then you need to figure out, how are you going to finance this transaction? And there are typically 2 different components for how you finance it. There's what's known as the equity piece. This is the money that is being invested with some anticipation of a return, some upside, some extra return if the investment performs well, downside, poor returns if the investment does poorly. And the types of investors who will put equity capital into a transaction, there are high net worth individuals and families. Pension funds are big investors in timberland, foundations, endowments, funds of funds, variety of institutional and individual investors who are looking to own timberland, or again, other rural real estate with conservation attributes. Often it doesn't make sense to finance a transaction only with equity. Often it's helpful to borrow some money to make up the gap between how much you can bring in investment capital, and also, if things go well, to generate better returns for the equity investors, because the folks who lend the money just want their money back. They don't need anything more than that. So different types of lenders who will put money into a conservation transaction. There are banks. There's the Farm Credit System, which is a quasi publicly supported network of lenders. There are more esoteric programs. The Federal New Markets Tax Credit Program can be a source of attractive debt financing. There are program-related investment opportunities where PRI sponsors will lend money into a transaction. Sometimes the support for those PRI investments comes from charitable donors. So we'll talk in a moment about a particular case study, but the Lyme Timber Company borrowed some money a number of years ago from the Conservation Fund, which sourced some of the capital for that transaction from charitable donors who wanted to support the work that we were doing. There are clean water state revolving loan funds. I think Peter's going to talk, well, I might talk a little about that today, but sources of capital that are designed to protect watersheds and water quality. And then loans even from conservation NGOs of the sort that are in this room under appropriate circumstances. So equity capital, sort of the risk capital that comes in that's looking to earn a return, and then loans to make up the difference. So, okay, you can get the money to put into the transaction, but then how are you going to get the money out? What's going to generate an investment return? And there are a variety of sources of investment returns that can generate, get money back to the investors and pay back the lenders so everybody is happy after the transaction's over. Lots of different sources of investment returns. In industrial timberland properties, the Lyme Timber Company owns 1.3 million acres of timberland around the US, and we do a lot of sustainable timber harvesting, and that generates cash, and that cash goes back to investors. We sell conservation easements, talk a little about that in a moment. And we engage in what are known as payment for environmental services programs, so mitigation banking, sale of carbon offsets, a variety of other mechanisms that Lee mentioned as well. We can lease out the properties that we manage and own to hunting groups, fishing groups, recreational groups, and that generates some investment return. And so the combination of those cash flows, those sources of money coming in after you purchase the property, all generate an annual amount of money that can go back to investors. Investors like to get their money back. Lenders like to get their monthly or quarterly interest payments. Everyone's happy. And then at some point, we have to sell the property, because typically, at least the way our funds have been set up historically, we tell our investors, invest your money with us for 10 or 12 or 15 years. But at the end of that time, we're going to make sure you get your money back. And the only way that we can make sure investors get their money back is by selling property to someone else, taking the proceeds of those sales, giving them back to investors, winding down the fund, and everyone goes away happily. So that's just a canonical framework for how to think about transactions generally. I'm going to overlay this on a specific case study, but let me first pause and see if there are questions about anything I've said so far. Yes. You need a microphone though, so folks online can hear you.
It's more intimidating to ask a question with a microphone.
You're among friends.
My name is Soraya. I'm from Blue Forest. I was curious, you said at the end of this transaction process that in this case, Lyme Timber Company would then sell the land. Who would you typically be selling it to at that point?
Great question. So often we are selling the property to another investment fund or another investment organization. Often what happens, so if you take, for example, the case of a conservation easement sale. So let's say that we bought a piece of property and we managed it for sustainable timber production, but we also sold the conservation easement, and that conservation easement put a perpetual encumbrance on the property and said, you can never subdivide it, you can never, cut down all the trees and put up shopping malls, you can't do unsustainable timber harvesting. That's a perpetual restriction on the property. When we sell the property, we need to find a buyer who's willing to take it subject to those restrictions, because the restrictions travel with the land. And so often we're looking for buyers, and there are such buyers who are willing to buy a piece of property that is essentially a pure engine for conservation and generating sustainable timber harvesting revenues, and maybe revenues from ecosystem services, but nothing else. You can't convert it into another property. That's a more limited universe of buyers than the universe that is willing to buy any piece of timberland. But it's part of our investment thesis, is we're trying to achieve this conservation outcome along the way. And the buyers understand that and need to be comfortable with the restrictions they're going to inherit.
Thank you. My name is Lita Cunningham. I'm with the Lighthouse Conservation Group, although I'm Coastal Conservation Finance in the papers here in North Carolina. So this is a really interesting model. It sort of assumes that the seller sort of exists. And I wonder, how do you get, say, people who own a lot of farmland in Eastern North Carolina that the value is going to be decreasing for agriculture? How do you get them to become a seller? How do you go the other way?
It's a great question that probably there are other people in this group who are better qualified to answer than I am, since you are often the folks who have the relationships with landowners and are trying to articulate some reason why they should engage in some sort of a transaction. We're often, just because of the scale at which we operate, we're often dealing with larger institutional grade owners of timberland. But, you know, generally speaking, you've got to make it worth their while. You've got to put a proposal in front of them that is more attractive to them than whatever, you know, benefit they would have from continuing to own and operate the property. So often that takes, as Peter likes to say, 1,000 cups of coffee to, you know, get inside their head and understand what they're really interested in. And, you know, some often creative financial structuring and other kinds of arrangements that, you know, we'll get into a little more today and later as well. Peter.
Hello, Iman Musa from Credit Suisse. Just a question about like selling the property to another investment organization. Why don't you keep it and kind of put it in a new fund rather than putting it out?
How do I answer that question? I'll give you the cleanest legal and regulatory answer I can, which is that historically, all of our funds have had a fixed term. And we commit to investors that they need to, that we will wind down that fund after, call it 15 years. And they are essentially, guaranteed that we're going to liquidate all our investments and get their money back and hopefully a nice return on their money. The possibility of selling a piece of property from one fund to another fund is one that we certainly have thought about, are thinking about. It's complicated for a variety of reasons, but within the confines of the existing funds that we have today, we got to sell it because the term runs out.
Because I'm willing to spend time in the Danbury Correctional Institute, because I've checked out their tennis courts and things like that. I'll give you a clearer answer quietly, but no, I won't. But going back to the earlier question, and it's something that David alluded to, not as much frequently, but up until a few years ago, probably half of the transactions that Lyme Timber pursued were brought to us by conservation NGOs, meaning I didn't have to have the 1,000 cups of coffee. It was really the trust that local landowners had with local, regional, national land conservation groups, where they weren't willing to be purely patient owners and wait. They had a family reason or a corporate reason or a financial reason for putting the property on the market, but could we kind of deflect the market for a little while by having the NGO, the land trust, partner with a group like Lyme Timber and still compensate the family, the corporation, the entity fairly. And that's still the example that I'll share on Thursday. One of the examples is a project that happened that way, where a land trust brought us into the transaction.
Let's take one more question and then I'll save some time for questions at the end. There's one.
Hi, I'm Annie Maloney with the Foundation for Sustainable Forests. And I apologize if you said this at the very beginning, but are the investors that you're working with coming into this with a charitable mindset when it comes to return on investment?
No, our investors are not. We have investors that consider themselves impact investors and are looking specifically for managers who will deploy their capital in a way that also has some environmental benefit. That's about half of our investors. The other half are purely in it for the money and couldn't care less about the environmental impact. So it's sort of interesting. It gives us two masters to serve, and it forces us to confine our activities to the overlap, in a Venn diagram of those deals that have, market financial returns, are going to generate returns that are commensurate with what any other timberland investment could generate, but also have some environmental benefit. And over the years, we have developed and utilized a bunch of tools that we think can actually generate above market returns by virtue of some of these conservation strategies. But the universe of transactions where those can be successfully deployed is very limited.
Your investors are not fairly, but some of the providers of debt. You say that?
Yeah, I will repeat it because Peter Howell says, points out correctly that while our equity investors are not charitably minded, or they're not making the investment for charitable purposes. There are lenders, so conservation NGO lenders who have a charitable purpose. There are donors who are supporting PRI investments that have a charitable purpose. So we're able to blend in charitable capital typically through the money that we borrow, but that's not the focus of our equity investors as they get into timberland. Okay, let me move on. I will save some time at the end for cleanup questions. So here's the case study that I'm going to overlay onto that structure. So back in 2017 and 18, we bought a bunch of about 67,000 acres of timberland in north central Pennsylvania, some of the most high quality black cherry property in the world. In two different transactions, one from a TIMO called the Forest Land Group, another from Hancock Natural Resources Group, now Manulife. And you can see some very nice cherry trees here and the diagram of where all the property was located. This is north central Pennsylvania and southwestern New York. And the financing, the equity capital came from our funds. Talk about that in a moment. Some interesting financing on the debt side. So we borrowed $50 million from Pennsylvania's Clean Water Revolving Loan Fund from a group called PennVest, the Pennsylvania Infrastructure Investment Authority. We borrowed $17 million from the Conservation Fund, also to support the purchase alongside our fund, the funds that made this investment. And thinking of the investment, the return strategies, the plan was we're going to do sustainable timber harvesting subject to third-party certification under the Sustainable Forest Initiative, or SFI. We're going to invest in 2 sawmills that are in that area that give us access to both foreign and domestic markets for lumber and give us a lot of visibility into what's happening in the lumber markets. And the plan was and continues to be to sell working forest conservation easements to the Pennsylvania Department of Conservation and Natural Resources. So that was sort of big picture, the thesis when we made the investment in 2 separate transactions in 2017, 2018. So how does that look based on the framework that we just talked about? Well, our sellers at the top were the Forest Land Group and Hancock. The equity, the capital that was put at risk, the investors who are looking to make as much money as they can, came from 2 of our funds, the Lyme Forest Fund 4 and the Lyme Forest Fund 5. Those funds had got their money from foundations, endowments, high net worth individuals, and so forth. And then the debt, as I just mentioned, 20 million of it on very attractive terms came from PennVest. They lent us the money at 1% interest for 20 years, fixed rate, interest only for the first 5 years. That looked like a great deal then, and it looks like an even better deal today. And then this debt from the Conservation Fund. Now, why would the Conservation Fund, the Conservation NGO, lend money to a private equity firm of all things? Well, the way we structured that arrangement was that by lending us money, the Conservation Fund got an option. And that option was that for a period of 7 years, they had the exclusive right to purchase a conservation easement over the property at a price that was going to be determined by appraisal. And we couldn't do anything inconsistent with a conservation easement for that 7-year period. So as long as they'd come up with the money in 7 years, they'd be able to purchase the conservation easement. Now, their plan was never to use their own money. Their plan was to go and work with the Pennsylvania Department of Conservation and Natural Resources and come up with public funding in order to then exercise the option, and then the easement would be conveyed. So that's why, and the way they secured that option, the way the Conservation Fund was able to get us to essentially commit to that transaction was by lending us money at a below market interest rate. So the benefit to Lyme was we got money at a low rate. benefit to the conservation fund was they were able to secure these option rights. And if everything plays out as expected, they'll get their money back and the conservation easement will get transferred. So we still own it. We don't have a future buyer yet. That's TBD. But you can see in the context of a specific example, this is one configuration of parties and types of players in the ecosystem and how they all came together for a particular transaction. Questions?
Why only 7 years? Because if you had the loan for 15 years, why did you only have 7-year option? I'm curious.
It was a product of negotiation. It's a question of how long were we able to essentially refrain from doing anything else with the property, and how long would the loan be outstanding? Sometimes we've had shorter periods of time. It depends on the expectation of how long it's going to take to assemble the public funding in order to then finance that easement. How low the rate is that the NGO is willing to provide us on the debt. So there's nothing magic about the number.
Peter Howell, CFN. So I just had a follow-up question. Can you explain for us exactly how the debt affects your rate of return? And maybe you're going to get into that in a second. Just so we understand how you guys work, because I think for conservationists, the inside world of finance can be a little confusing because we never really hear all the numbers.
So the third part of the presentation,
Yeah.
we're going to dive
Okay,
deep into
we'll
the
wait.
numbers. And if I
Thank
forget to answer that,
Sure.
wave me down. Okay. All right. One more question, then we'll move on.
So is it right that the Lyme Timber Company sets up the funds and then invests in projects? Is that
That is
how
correct.
it works? Yeah. And so
but specifically the equity piece of it. So we set up this portion,
Yes.
and we then bring the other parties together in order to make it all in the transaction. Yeah. Okay. All right. So this is where we go way up to 100,000 feet and talk about. So with that in mind and some basic understanding of how a transaction can be structured, let's talk a little about what motivates, what drives private investors or private investment managers to do these kinds of transactions. Again, for the purpose of knowing what the folks across the table from you may be thinking and may be focusing on. So why might conservation organizations or agencies need private investors in the first place? Well, public capital is harder and harder to come by. It's increasingly difficult to simply buy a property and flip it to a public agency. And there are a lot of lands that remain to be protected. Our focus is in the United States and Canada, so that's really all I can speak to, but certainly that is the case more, beyond North America as well. And so private investors have, can fill a gap between the universe of conservation projects that can be done, deserve to get done, and the capital available to actually make them happen. And so the private investors have over time played an increasing role in conservation. We talked about ESG investing and impact investing and all those buzzwords, but there's certainly a lot more focus with this generation of investors than perhaps there was 20 or 30 years ago. There are new markets that people talk a lot about. You'll hear a lot about carbon markets and mitigation markets and other payments for ecosystem services. Some of these investments are very advantageous from a tax standpoint for investors who are trying to figure out how to optimize their tax situation. Whole section of the Internal Revenue Code that focuses on timber and stumpage purchases and sales. And there's just a lot more private capital available than public capital. And so being able to deploy some of that for conservation transactions makes sense both for the investors and for the investees, if you will. What investors are really looking for is they want access to interesting transactions. The question of how do you get someone to be a seller? Often investors like the Lyme Timber Company are depending on conservation NGO partners to help identify some of those prospects and bring them to us, because you have the relationships and know what the priorities are, and we have the capital. And so that provides us with a source of what we like to call proprietary deal flow, sort of a buzzy kind of word, but the idea is deals that wouldn't really come to any of our competitors because we have a track record and a reputation for doing these conservation-oriented, complicated transactions. And working with conservation NGOs in a way that I'll describe provides some additional credibility to us as the investor. Those are some of the reasons that private investors are brought into transactions like this. And investors, for their part, and here again, I'm talking about equity investors, the folks in that upper left corner of the chart, see investments in timberland and in real estate as being stable investments, as being a good hedge against inflation, something that people weren't talking about so much a couple of years ago, but now everybody's talking about. These are investments that tend not to rise and fall with the stock market. That's generally a good thing for big investors who invest in all kinds of different asset classes. And there are lots of long-term drivers of returns. There's a finite amount of land that exists. They're not making any more of it. And the finite number of conservation opportunities. There's development pressure, population growth, other kinds of markets that are evolving, and different sources of value that may be of interest to different types of investors. So we talked about some of the more traditional revenue streams from timber harvesting, and from leasing, and from doing limited development, or what's more recently called conservation development. But conservation, carbon offsets, mitigation, banking, other payment for environmental services, renewable energy siting with all the money that has come in through the infrastructure bill and the Inflation Reduction Act. We have had a lot more activity being approached by wind and solar developers looking to do renewable energy on our properties. And so lots of opportunities from an investor standpoint to do things that are following and capitalizing on market trends. Problem is, investors, investment managers tend to be extremely, extremely selective. And when we get into some of the weeds in a moment, we will talk a little more about why. There's what I often think of as a symbiotic relationship between private investors and conservation NGOs. Conservation NGOs get the benefit of working with somebody who actually has a checkbook and who can come up with the capital on relatively short notice. We have the ability, Peter and I and our other 4 partners can call capital from investors on 10 days notice, and we don't need to get anybody else's permission. And we can put together pretty innovative deal structures. There aren't, rigid rules and RFPs that need to be filled out in order to access our capital. It's interesting from a political standpoint because having a private investor who is participating in a transaction can appeal to both sides of the political aisle. We did a transaction in Wisconsin in 2011 where Scott Walker was the Tea Party governor and did the largest conservation easement sale in several phases between 2013 and 2016. And Governor Walker signed off on all of it because there was an economic development story. It wasn't all about conservation. We were keeping these lands forested. We were allowing the forest products industry to keep doing sustainable timber harvesting. The word conservation didn't appear in any of our public statements to the Wisconsin legislature. So there's this interesting synergy between private capital and conservation from the political standpoint. We have the ability to execute and the credibility to say that our money is going to be there when the closing happens. And then from the other side, investors depend on conservation NGOs for the expertise and the local knowledge and the relationships with public agencies in a given state or county to help monetize those conservation values. So I think I'm not going to pause quite yet because I don't want to run out of time, but hold your questions and we'll get to them. I want to talk about one particular tool that I've referenced a couple of times. We've talked about conservation easements, but in particular, this flavor of what we refer to as a working forest conservation easement. And this is a tool that the Lyme Timber Company really pioneered several decades ago. And when Peter joined Lyme in 1990, 91, it became a principal mechanism that Lyme used to generate returns and conservation outcomes at the same time. And the basic concept works like this. So we buy the property upfront, T equals 0. And we buy a property that has been identified by conservation groups, public agencies, others as being particularly appealing from a conservation standpoint. And then we enter into an option agreement of the sort that I mentioned with the Conservation Fund in Pennsylvania, where we will grant an option to sell a conservation easement for some period of time. And in the case I described, 7 years. And then over the next several years, we'll work in partnership with the conservation NGO to get approval for the various funding sources that are going to be necessary to sell that conservation easement. And so, unlike what many conservation NGOs are used to, we're not talking about donating a conservation easement. Half of our investors are tax-exempt foundations. They don't get any benefit from a donation. So we can't donate easements because then only half of our investors are going to benefit from it. What we do is we sell the conservation easement at appraised or yellow book value. And we need, therefore, to find some source of funding that's going to purchase that conservation easement from us. And so that's sort of the gray box here. And when we sell that conservation easement, we are essentially relinquishing the right to do a bunch of things. We're relinquishing the right to develop, to subdivide, to do unsustainable timber harvesting. Often we're relinquishing the right to exclude the public, which is a convoluted way of saying we provide public access to these properties. So all those rights get extinguished. And what we're left with is the green box, which is the land that is subject to the conservation easement. And often we find we can sell that gray box, the conservation easement, for something between 30 and 50% of what we paid for the property. Then what we're left with is the conserved property, but we have reserved for ourselves the right to do sustainable timber harvesting as long as we're either third-party certified or complying with whatever specific restrictions are set forth in the easement. And so we spend several years optimizing the property from an investment standpoint, getting the right people in, the right foresters, the right logging contractors, making sure that we can run essentially a profitable business doing sustainable timber harvesting and maybe doing some other things as well around carbon or mitigation or other payment for environmental services activities. And then when we near the end of our 10 or 12 or 15 year period, we look to sell the property to someone who's going to take it subject to this easement. But over time, the value of what we have is growing because we've demonstrated a profitable growing business that can generate cash flow. And so this is a way to think about our investment thesis and how we as an investor are able to encumber the property, generate the conservation outcome here in phase 2, and then through the cash flows from ongoing activities, and then ultimately the sale of the property, generate what's hopefully an attractive investment return for investors. Let me pause there for questions.
Harry Guinness at New Leaf. This is a simple or complicated question. Selling or for the conservation lender who is offering you a discount on the interest rate for that option, i.e. paying you for that option, do you need that entity to exist, or could you enter in without that low-cost capital upfront and still find a WFCE counterpart down the line? So how does that logic work and play out?
Yep. Great question. And the answer is it depends. We have certainly done transactions where we don't have a low interest rate conservation lender. Sometimes we find other sources of low interest rate debt. It all depends on the numbers. So we'll talk in the next section about modeling cash flows and figuring out what kind of returns an investment will generate. Generally, if we are going to be competitive with other potential buyers for a property, we need to bring something to the table that allows us to win what is sometimes a competitive bidding process, hopefully not too competitive, but we do find ourselves having to be in a bidding war. And one of the ways that we can bid a little more money than the next player is by having access to low-cost debt. That was certainly the case in Pennsylvania. So is it an absolute requirement? No, it just depends on the dynamics, who the counterparty is. We bought another piece of property, interestingly, adjacent to this Pennsylvania property in the depth of the pandemic in December of 2020 from an oil and gas company that needed to sell 90,000 acres because they had committed to another transaction and they needed the money. Nobody was doing transactions at that time. You may recall, nobody was flying on airplanes or staying in hotels. So how could you get a team to go and do diligence? Well, we took a little propeller plane and we brought some tents and we camped out on the landing and we did the timber diligence on the property. And we were the only bidder there. And we bought the property for probably less than half of what it's appraised at today. We didn't have a conservation lender. We didn't need one. We were able to get the property at a price because, again, there was no competition that didn't require that additional piece of value. But it depends, as is often the answer to these questions. All right.
One more question over
One
here.
more question.
There are two areas that you mentioned that I'd love to hear more comment on: the setting the value of the conservation easement. You said that's a gray area, and I know that that is typically extremely gray, extremely unknown. How do you set a value on that when all the parties might say something different? And then the selling the business and the land, how do you set a value on that? Do you have an expectation for your profit and then kind of backtrack what you'll sell it at? So those two areas, could you talk a little bit more?
Yes. The second one is a perfect segue into the next section. So I'm going to take the second one as we go through the next section, but let me answer your question about conservation easements. So when we are expecting to sell a conservation easement to a public buyer, typically public buyers can't pay anything more than appraised or yellow book value. And so we have to make some assumptions and educated estimates about what the yellow book value is going to be. And what we'll often do is we will negotiate an option agreement with a conservation NGO that has a floor value. And that floor value is essentially the minimum price that we would be willing to sell the conservation easement for. And if the appraisal comes in below that price, we're not obligated to sell the easement. So we essentially are protecting ourselves from the possibility that the appraisal comes in low. If the appraisal comes in higher, then we'll sell it for the appraised value and the option can be exercised. And Peter and Matt Singer later this week are going to talk about a transaction that we did in Texas that worked very much like that. But you're right, it's not known. And so in our modeling of the investment up front, we need to make some assumptions and build that into our floor value, because we know that if the appraised value comes out below the floor value, it's just not going to be economically feasible for us to sell the easement. We'll have to pursue some other strategy. Let me hit your second question in the next section. Okay. Here's where folks who are finance experts can take a snooze. Because we're going to talk, even though this is a busy and intimidating slide, we're going to talk about some very basic concepts very slowly. And as we dive down into the weeds here, my plan is to show you how these concepts inform the process that a private investor goes through in figuring out how much to pay for a property, how much to set a floor value for a conservation easement, and whether or not a transaction makes sense. I had said earlier, private investors are very selective, and it's through the process of financial modeling that investors tend to weed out probably 90+% of possible transactions because they don't meet the criteria that an investor is looking for. So here are some basic concepts of how that works. The first principle is what's known as the time value of money. What does this mean? It means that $1 today is worth more than $1 tomorrow or in 5 years. Why is that? Well, you can take $1 today, you can put it in the bank, you can now get a decent rate of interest on it, and 5 years from now, it will be worth more. And so it stands to reason that if you had $1 5 years from now, today it would be worth less. And this basic concept that money is worth more over time underlies everything that investors think about in terms of investment returns. And so this concept of the time value of money is helpful in evaluating in today's dollars, in 2023 dollars, what some future investment returns might look like. And so you may have heard the concept of present value. Present value is the value today of future payments. Maybe it's an annual payment, maybe it's some lump sum payment in 5 years, but discounted back to today's dollars at some rate to reflect the time value of money and the possibility that those payments don't ultimately materialize. So present value is this, takes into account the time value of money and bringing future projections of value of amounts back to today's dollars. So let's take a very simple example. Let's say that somebody offers you the opportunity to make a $100 investment. And you know with absolute certainty that if you make this $100 investment, you're going to get $10 back for each of the next 5 years. And that at the end of 5 years, you're going to get $120 back. So on its face, that seems like a pretty good deal, right? You're making money. You're getting back more than you put in, plus you're getting some money along the way. Well, how would that investment look to an investor, to a professional investor? So let's look first at this undiscounted line. So the number in red in parentheses is the amount of money that's going out. Black numbers are the amount of money that's coming in. You've got $100 going out, then you've got $10, $10, $10, $10. And then in year 5, you've got your $10 plus the $120 that I said you'd get back at the end of the deal. So it's $130. So if you add up those numbers, you get $170. This does not take into account the time value of money. That's why it says undiscounted. We'll get to that in the next line. So $170 is the present value of those future cash flows. 10 plus 10 plus 10 plus 10 plus 130. And then you see I've got this other column, NPV, which stands for net present value. And that's simply the 170 minus the original 100 that you put in. So you put 100 in, get 170 out, and 70 is essentially your profit. It's the amount of money that you've gotten back above and beyond what you put in. Okay, pretty good deal, $70. Well, now let's think about the time value of money. And I referred earlier to discounted at a specified rate. So what if we chose sort of arbitrarily a 5% rate? Well, what we'd say is, okay, $100 today is $100 today because it's today. But a year from now, that $10 that you're going to get discounted back is only worth $9.52 in 2023 dollars. And in the next year, that $10 is only worth $9.07. Year after that, $8.64. So these numbers represent the discounted value of that $10 payment in each year, discounted back at 5% per year. 5%, 5%, 5% gets back to that number. The 130, if you apply a 5% discount rate, is 101.86. Now let's add up these numbers and we get $137.32. What does that number represent? It's the present value of those 5 years of cash flows discounted back at a 5% discount rate. So 137 is the present value at that 5% rate. You subtract the $100 that you put in initially, you've got $37.32 as the net present value. 137.32 minus 100. Okay, you can all probably predict what's going to happen next. If you increase this discount rate, if you put even more emphasis on the time value of money, well, then what happens is that each future cash flow is worth progressively less. So if you take your $10 in year one, we're now on the third line, the 10% line. You take your $10 and discount it back at 10%, it's only worth $9.09 and $8.26 in the next year. And you add these all the way across, and you've only got in discounted future cash flows $112.42 because you've applied this higher discount rate, this 10% rate instead of 5%. Subtract our $100, $12.42 is the profit, the net present value of the investment after subtracting the $100 you put up front. And if you drive the discount rate high enough, so in this case, 15%, and now of course these numbers are correspondingly lower. Now the present value of adding up those future cash flows discounted back at a 15% rate, $93.18, hey, that's less than the $100 you put in. And so if you subtract $100, you're actually losing money on this investment. It's got a negative $6.82 NPV, or net present value. And so the important concept here is the higher discount rate you use, the more that reduces the value of those future cash flows and reduces the effective investment return that you get from discounting those cash flows back at those rates. So I'm guessing there are a bunch of questions, and then we'll talk about the bottom of the slide.
Question from a virtual attendee. This is actually kind of a couple slides back, but what is the appraisal process timeline, costs, time, etc.? When are you initially making the bidding for a property?
What are you initially making the
Bidding?
bidding for the property? There's no single unified answer to that question. The timeline for appraisal, again, it depends on if you're talking about federal money or state money and which of the 50 states. And so there isn't a, the glib answer is a long time, and it takes an increasingly long time with the passage of time. But that's something that needs to be answered in the context of a particular transaction.
Thanks for that. I've always struggled with net present value, I have to say.
You're not alone.
But one thing I have struggled with, and maybe this is getting a bit too technical, but how do you factor in inflation in a net present value calculation?
Also a good question, and probably beyond the scope of what we're going to talk about in the remaining, however many minutes we have, 20. There is the terms that you may have heard of are nominal versus real rates of return, and nominal rates of return take into account inflation, the rates of return net out inflation. In building a financial model, the common thing to do if you're talking about nominal rates of return is to build in some assumption about inflation and have that affect what those future cash flows are going to be. So if the future cash flows are subject to inflation, then you're discounting back inflated cash flows, and then you're essentially taking into account the inflation when you apply your discount rate. Other question online. Oh.
Testing. There we go. Another question from a virtual attendant. Is the discount rate usually disclosed, or is that a risk you need to calculate yourself?
So that's a great segue to this next section, and whether it's disclosed, maybe I'd reframe the question a little bit and frame it in terms of how do you determine what an appropriate discount rate is? Whether it's, disclosure suggests that you've got two parties to a transaction, and here we're just talking about the fundamental question of how do you value, how do you make an investment decision? I'll talk in a moment about how much information might be shared between one party and another. But the question of what is that discount rate, how does it get determined, is an important one. And one way that it can get done, that it can be calculated for a given investor, is an investor will say, well, I need to think about what's the risk-free rate, just the inherent time value of money to me, of putting my money to work. But then, because I simplified this example by saying, for absolute certain that you're going to get $10 a year. Well, that's not the way the real world works. And if you think about that as being not some hypothetical example, but the likelihood of generating revenue from, the sale of logs or carbon offsets or something else, there's always uncertainty. And so there's often a risk premium that gets added to some risk-free rate in order to come up with a discount rate that essentially captures not only the inherent time value of money, but also the risk that those cash flows don't come to pass as anticipated when you're building a financial model. Sometimes investors have a stated required rate of return. Maybe someone like the Lyme Timber Company has told our investors that we're only going to make investments that have a return profile that's above X%, and therefore we can't really use a discount rate that's lower than that because we'll end up disappointing our investors. And there are a variety of formulas that take into account what's called the weighted average cost of capital, where you think about what's the debt, the expected return on the debt versus the expected return on the equity. So there are a variety of different ways to calculate it. Whether it gets disclosed and to whom is a matter of negotiation between the parties. But a critical question is, how do you even know what that rate is in the first place? And the answer is that what investors tend to do is to build a financial model, to build a forecast of how a particular investment is expected to perform. And so investors will start with a spreadsheet that contains a forecast of future cash flows. So whenever we make an investment, or whenever we contemplate making an investment, we say, okay, we're going to pay X for the property. What do we think it's going to generate in year 1 and in year 2 and in year 3 from whatever our various sources of return are based on our strategy? So how much are we going to sell in log sales, and how much are we going to sell in carbon offsets, and how much are we going to sell, generate from recreational leasing or renewable energy leases and so forth. And once you have that forecast, you can solve for the effective discount rate, and that is known as the internal rate of return, or IRR. IRR is a concept that people often find confusing, and hopefully with that background, it will now all become clear. What is IRR? Well, it's sometimes referred to as the annualized compounded rate of return on an investment. But the clearest way to think about it, I think, is it's the discount rate at which forecast cash flows will generate a net present value of 0. So let's go back to the little diagram. So looking at these NPVs, this is at a 0% discount rate, the $70. 3732 is getting a little closer to 0. 1242 is getting closer to 0. Whoops, at 15%, we're below 0. So just eyeballing this, probably somewhere around between 10 and 15%, maybe 13% is the rate that if we had a 13% row here, it would discount back these $10 cash flows such that the present value is exactly $100 and the net present value is 0. That's the internal rate of return of this set of cash flows. So again, remember, the set of cash flows is $100 in, $10, $10, $10, $10, $10 plus 120. What's the internal rate of return of that set of cash flows? Call it 13%. If you discounted back those cash flows, each at 13%, that number in that column would be 0. So what's the significance of that? Well, IRR is very important for evaluating a series of irregular cash flows, which again is often the case in making any investment. And it's how investors typically think about how risky and how rewarding a particular investor is. What is the IRR associated with this future set of cash flows in the model that we've built? Now, IRR is not the only thing that investors look at. Investors also look at what's known as equity multiple, sometimes referred to as cash on cash return. And that's a slightly different question. It's, okay, forget about the discount rate. What's the total amount of capital that I'm going to get back after I put my money in? So going back to the chart here again, really what we're talking about here is this number. Assuming a discount rate of 0, I'm going to put in 100, I'm going to get out 170. That means that my equity multiple, the amount that I'm going to get divided by the amount I put in, is 1.7. 170 divided by 100. So those two tools, IRR and equity multiple, are the critical building blocks in understanding how investors think about whether an investment is a good investment to make. Let me pause there because this is pretty dense stuff. Yes. Oh, microphone.
Thanks for this. So do the investors look to you to estimate those numbers, or they come up with their own and then want to see what you would say? Who figures that out?
Okay. So in the context of our business, we have investors who are the investors in our funds in that upper left equity corner of the chart. And they entrust us with their capital, and then they step out of the way and let us make the investments. So our investors, the investors in our funds, bless you, don't have any involvement in any of this. We, as an investment management firm, are building the financial model, doing the financial analysis, doing what's called sensitivity analysis, which I'll talk about in the next slide, and figuring out which investments are good and how much to pay for them. Our investors don't have any involvement.
Hi, Carrie Kasnica from the Trust for Public Land. So on something that like this, where the return is also dependent upon performance and what you're anticipating, something like COVID, that's now on year 3.5. What happens when it either defaults or just something that interrupts the equation that you know you're not going to get that back? Do you have any examples of maybe that might have happened that you're aware of recently?
Well, all the time, because nothing ever goes as planned. So I'll give you two answers to the question. First of all, a forecast, a model, is only as good as the assumptions that go into it. Nobody anticipated COVID, and so a lot of things didn't perform as expected. And so the simple answer is, if you expect a certain, level of future cash flows, and then that level of future cash flows is lower, it's going to have a poorer outcome from the standpoint of investment returns. The slightly more nuanced answer is that depending on what discount rate you applied in building your financial model, you may have more or less cushion to absorb those unexpected events. And so if you modeled an investment using that 5% discount rate line, and then COVID hit, well, it would probably end up underperforming what you expected. If you modeled your investment with a 15% discount rate, then you've got more room in the future because those future cash flows are reduced. They're discounted back more significantly as a result of the discount rate that you've applied. And so you have more buffer or cushion to absorb those unexpected future events.
Maybe a way for some of you to think about it who've been involved in development and advancement is you may be really good, you may be really lucky, but you probably don't get 100% of the solicitations you make to donors or foundations funded. And David's about to go into sensitivity analysis where we're doing something quite similar. We're going to say, well, it ranks pretty high for the regional allocation under the Forest Legacy program, but maybe it's not going to come in the top 3. Maybe only a phase of the easement can happen by year 2, not 100% of the. So just there, I have a sense that many of you are already doing this kind of analysis, but for a different reason.
Okay, 1.5 slides left. I do want to save a little bit of time for questions. So let's talk for a moment about a couple of things that you may encounter or you may have encountered in talking with private investors who may seem extremely greedy. And the principle here is the importance of purchase price in driving investment returns. So I'm going to give you another very simple example. Let's say that you have the opportunity to make an investment today. You're going to put out $100 and you know that in 5 years, you can sell that investment for $200. Take my word for it that if you plug that into Excel, it's a 15% IRR. We don't need to go through the math now, but you can probably in your head see that it's a 2.0x multiple. Put in 100, get out 200, 200 divided by 100 is 2x. If you can negotiate a price and buy that investment for only $80, well, the IRR is going to be higher. Take my word for it. It's 20%. And again, you can do the math in your head. 200 divided by 80 is 2.5x. So this should be pretty intuitive. The less you pay for something, when you know you're going to get a certain amount out in 5 years, the better an investment it's going to be. But let's think about what happens if you layer on some interim cash flows on this investment. So now we're going to go back to our previous simple example. $100 goes in and you've got, that's not exactly the original example, $10 each year, but then let's assume in 5 years, you're selling it for 100. Previous example is 120. So $100 in, $10 out each year, $100 back at the end of 5 years, sort of like a bond. The IRR here is 10%. The multiple is 1.5. Why? 100 plus 10 plus 10 plus 10 plus 10, 150 total divided by 100, 1.5 times. Okay. Well, let's assume that instead you could make an investment where you're putting in $100 and you're getting $20 each year instead of 10, 20, 20, 20, 20, 20. And then at the end of it, maybe you're depleting the asset and it's not worth as much afterwards. You know, you've cut down all the trees in the forest. And so you're only selling it for 50. Well, let's do the arithmetic. $100 goes in. You're getting out 20 a year for 5 years. That's 100. You're getting out 50 at the end. It's 150 total. 150 divided by 100, 1.5x. It's the exact same equity multiple between these two, but the IRR is higher. Why? Because you're getting these interim cash flows that are higher, and the interim cash flows are discounted back less because they're closer to when you've made the investment. So here's the slide where this all comes together. So what investors do when they consider making an investment is they engage in what's called sensitivity analysis. And so we can make this a little more realistic and use hundreds of thousands of dollars instead of $100. So you can buy a timberland property for $100,000. You can get $10,000 a year from annual timber harvesting cash flows. And then you've got two options. You can either sell the property for $120,000 in year 5. This is exactly the same example we started with, except with 3 extra zeros at the end. Or you can pursue a different strategy where you sell a working forest conservation easement in year 3 for $40,000. And then you sell the property subject to that conservation easement in year 5 for $90,000. Why are you selling it for $90,000? Well, it's worth less. Those are two separate words. It's worth less. It's not worthless. It's worth less than the other because you have conveyed this conservation easement and it has all these restrictions on it. So how would an investor model the range of possible outcomes given these potential strategies for executing on the investment? So let's start with the first case, the first row in the sensitivity analysis. So you've got $100 going out, $10,000 a year in timber harvesting, sell the property for $120,000 plus your $10,000 from year 5 timber harvesting. The IRR for that is 13%. If you plug that into Excel, that's what will come out. That's essentially the discount. Remember the definition. It's the discount rate that if you applied it to the future cash flows, you'd have a net present value of 0. but it's a way of capturing how attractive the investment is. Multiple's 1.7. Why? Add up all the positive numbers, 10, 10, whoops. Gave it all away. That's the button. Add up 10, 10, 10, 10, 130, that's 170 divided by 100, 1.7 times is the equity multiple. Okay, that's scenario number one in the sensitivity analysis. Okay, now let's take the second example, which is the working forest conservation easement. Buy the property for 100, $10,000 in the first year from timber harvesting. In year two, I'm sorry, in year two, $10,000. In year three, we've got our $10,000 from timber harvesting plus $40,000 from the sale of the conservation easement. That's why the number is 50. And then 10, and then 90 from the sale of the encumbered fee plus 10 is 100. If you add up all those numbers, it's 180,000. That's why you have a 1.8 times multiple, and the IRR is higher. It's 16%. Now, here's the interesting one. Let's change nothing, but let's sell the easement not in year three, but in year two. None of the numbers have changed in total. We've still got the same amount of money coming in. We have $180,000 coming in, but because we have accelerated this cash flow from year three to year two, it gets discounted back less significantly. And so the IRR is higher, 18% instead of 16%. Let's assume things get even better for us. We can sell the easement in year two, and we can find a way to sell the property not for $90,000 plus our 10, but $100,000 plus our 10. Well, as you might expect, both the multiple and the IRR go up 19%. And then, you know, the jackpot is we get the seller to sell it to us for 80,000 instead of 100,000. And now we've got the 80,000 going out, but we've got 10 and 10 from timber harvesting cash flows. We're selling the easement for 40, and whoops, we've got a 24% IRR and a 2.3 times multiple. This is the skilled investor example. So what investors do, and this is where we'll wrap up and take questions, what investors do in the course of due diligence is to refine the assumptions that will drive different outcomes. So, you know, having a lot of conversations to figure out how much do we think we can sell the conservation easement for? How quickly do we think we can sell it? How much are we going to be able to sell the encumbered fee for at the end? How confident are we that it's going to generate $10,000 a year and not 9,000 or 11,000? So all of that information gets built into a financial model, at the end of which the investor says, okay, you know, at this price, it's going to generate an IRR of 9.7%. And that's attractive enough for our investors for us to make the offer. Let's make the offer and let's see if we can get the deal done. Okay. Questions? Are we out of time? 4:15. So I mean, we're at break time, but I'm happy to take questions if people want to take a few minutes. Yeah.
Again, Annie Maloney with the Foundation for Sustainable Forests. You're awesome. This is awesome. My question is about refining of the assumptions in that working forest easement example. I can wrap my head around just thinking about recent trends in recent years. I can wrap my head around refining assumptions about changes in the appraised value of the real estate. And I can wrap my head around the ups and downs of the timber markets, depending on what species you have on your property, that sort of thing. How does the value of the working forest easement track with either or none of those?
Well, you have to make, I mean, this is a question that you asked also in the back about the value of conservation easement. We would make some assumptions about what we think that easement is going to be valued at based on whatever data we have about appraisals or the things that might feed into an appraisal. And we may be wrong. We may be too low, we may be too high. When we structure a deal with an option to a conservation NGO, what we'll do, as I mentioned before, is we'll sometimes set a floor value and say, we'll sell you the easement as long as it's above X, X being sort of the minimum that our model would accept, you know, that would generate the IRR that our investors need in order for us to do the transaction. If it fell below that, we'd be relieved of the obligation to sell the conservation easement.
Just quickly though, isn't it really what's the development pressure in terms of what the appraisal is going to show?
So if I missed the point of the question, then yes, that's a great answer. I mean, what drives appraised value is what you're doing is you're measuring a before value and an after value. So in the case of the sale of an easement, an appraiser can go out and do a bunch of comp sales analysis and do an income approach and cost approach, market approach, and say, okay, we think this property is worth this amount today. And then what an appraiser will do is they will assume a hypothetical conservation easement, and the conservation easement will have whatever restrictions it has on harvesting, development, subdivision, and so forth. And the appraiser will go through the same exercise and say, well, if the easement were encumbering this property using our appraisal methodologies, the value would be X. The delta is the value of the conservation easement, and often that's driven heavily by development potential, but there are other factors as well. Question in the back there.
Okay, we'll take this one last question and then
I'm
David,
around.
are you willing to take individual questions
I'm
afterward?
absolutely willing to
Okay.
take them. I'm around through tomorrow lunchtime.
Zach Radmer, U.S. Fish and Wildlife Service again. Who pays for the actual appraisal process, right? Because in at least some instances, that's a pretty substantial cost. Is it you or is it the who's ever buying the easement?
Hand the microphone to my partner there. I'll answer the question.
So as much as we would like to hire, engage, pay for, and manage the appraisal process, we're not allowed to do that as the landowner. So most of the time there's an intermediary, a land trust, who is using a list of approved appraisers from a state or federal agency. But the way, particularly for the agency you're part of, the land trust can't even see the answer. The answer goes directly to the agency.
Can we?
Peter has.
If David Hoffer were to be working for a conservation organization instead of Lyme Timber, what are the critical questions he would ask when it came to doing due diligence on an investor that you might be partnering with? Anybody want to hire him here?
I think it's important to ask sort of the obvious questions. How many of these have you done? How familiar are you with the landscape of players, public agencies, other community organizations that are going to have a bearing on this particular transaction? Do you have experience owning and operating property in this region? How does this differ from other similar investments that you've made? What are your expectations for what would make this a successful investment for you? And mapping the NGO's objectives against the investor's objectives is pretty important. I mean, if there's just a completely different vision for what should happen with the property and how it's going to be managed, then that can be a very short conversation. You can save yourself a lot of time. I'd almost suggest that's sort of the first conversation to have. And if there's an alignment in terms of objectives for the financial and the conservation outcome, then you can sort of dig into these deeper questions about experience and compatibility and track record, and talk to references. Ask who else have you worked with, and can I talk to them? All right.
Say thank you to
Thank you
David.
very much.